Good afternoon, everyone. My name's Nick Hughes. I'm a private equity M&A partner at Clifford Chance in London. I spend the majority of my time advising financial investors on their transactions across Africa. A lot of that is within the energy and infrastructure space. So environmental sustainability is really a key part of many of those transactions. In the panel session this afternoon, we've got the opportunity to hear directly from 4 of the LPs. And really, all of them are involved in investing across the continent. I guess what I'm particularly keen to hear from them is around how they strike the balance between nurturing economic growth and safeguarding the environment. So to my right is Dia Martin, Managing Director from US International DFC. Then Anita Kova, a Director of Investments at the UBS Optimus Foundation. Catherine Cax, Managing Director of Investments at Soros Economic Development Fund. And then finally, Joseph Boven, a Director in the Equity Africa division of DEG. So look, as you'll have seen from that sort of brief introduction, the panelists' organizations all have quite different approaches to how they provide capital in order to sort of drive sustainable investments across the continent. So what I was going to do is start by asking each of them, how they go about investing, whether that's through debt or equity investments, or fund investments or direct, and also really just to draw out a bit the sort of point in the life cycle of a business where they feel that their organization can provide the most effective capital. So, Dia, why don't I come to you first?
Sure, thank you. I'm happy to be here. I work on the social enterprise finance team at DFC. And to take a step back, DFC is the US government's DFI. We have a portfolio of about 40 billion. 25% of that, about 12 to 13 billion, is focused on investment in Africa. And we run the range. We say that we invest from a couple of 100,000 all the way to hundreds of millions of dollars. And it goes all the way from project finance infrastructure to very earlier stage investments. And I work on the earlier stage side. I lead our Portfolio for Impact and Innovations program, where we make investments very early on in a company's life cycle. And we make investments in the form of debt financing to funds, as well as direct investments in companies. I'd say for us, we are the point of entry, especially as it relates to sustainability and impact for DFC. So we could come in with a transaction size, typically as small as 2 or 3 million, but normally I would say between the 5 to 10 million range, with the max being 10 million. We're longer term patient capital, which allows us the flexibility to invest in a number of types of transactions. So if you look at this portfolio, we have blended finance facilities as well as direct investments in companies. Sometimes we're the first institutional lender. And so that really, in our mind, helps us to support a lot of innovative companies to scale and grow. And I'll end with the Portfolio for Impact and Innovation right now is at 500 million, so $500 million across 80 plus companies, with a decent number of them being on the continent.
And I guess, you touched there on the sort of this Portfolio for Impact and Innovation. I suppose, what are your sort of return expectations from a sort of social impact perspective?
Yeah, so this portfolio was set up to be very flexible. So just to give you a sense of the diversity of what we have in our pool, we have, and this reflects the different return expectations. So we were one of the first DFIs to invest in a development impact bond. That impact bond is for a cataract hospital in Cameroon that was actually brought to us by a nonprofit organization. And our ability to get a return is based on that hospital's ability to perform high quality surgeries to the 2 bottom, quintiles of the population, so rural and lower income populations. So of course, our return expectations for that type of project are very different from our return expectations for one of our investments actually in Mexico, where we provide financing to one of the first digital challenger banks in the market to support SMEs. So there you would find a much more commercial return. With that said, we definitely have clear return expectations. Our desire is to mobilize capital from the private sector, not to crowd it out, but it really varies based on project. And I think that's one of the flexibilities we have as a DFI that we want to utilize to catalyze development.
Okay, thank you, Dia. Anissa, why don't I come to you next, and perhaps you can talk a little bit more about your approach.
Sure. So at the UBS Optimus Foundation, we do venture investments. That's debt and equity. And we work in the areas of health, education, and nature-based solutions for climate. Impact is at the center of everything that we do. So we work also through financial instruments that are impact-driven or impact-linked, such as development impact bonds, just like in Dia's example, but also impact-linked loans. And then another area of focus for us is blended finance. So UBS Optimus Foundation is an independent foundation, but it is aligned with UBS, which is the largest wealth manager in the world. So we do use the structuring and distribution capabilities of UBS to design blended finance products, such as funds or other structured note products. And one example of that is the SDG Outcomes Fund, which is a fund which invests in outcomes contracts or development impact bonds, where we used 20% philanthropic funding from the foundation to bring in other sorts of capital, such as from DFIs, but also through commercial investors in the UBS client base, such as family offices and high net worth individuals.
And do you find that sort of role you play within UBS, really helps you achieve that in terms of bringing in different sources of capital?
Yes. I think it's really important to think about how philanthropic funding, because it's so scarce, can be catalytic. And so we always look at structures where we can have that 5 times leverage, such as in the case of the SDG Outcomes Fund. We do have some challenges related to blended finance. I think we have also heard it in previous panels, just the communicating about blended finance, making sure that the complexities involved in these structures are still understood by the different types of investors has been one which we have experienced also within UBS, but I think still there is more and more openness, both from our asset management and investment bank practice, to work with us.
Yeah. Okay. Well, no, maybe we'll explore blended finance a little bit more later. Maybe Catherine, coming to you now and talking about Soros.
Yeah, an excellent segue. Going from one kind of foundation approach to the other one. So I sit at the Soros Economic Development Fund, leading the investment team, and just to position SCDF against the foundation and the endowment. So there's Open Society Foundations is the second largest foundation in the world, deploying more than $1 billion of pure grant capital on an annual basis. And then on the other spectrum, we have the endowment that is $25 billion that is basically funding the philanthropic side of it. In the middle, and a bit as a connective tissue, we have SCDF. So we are an impact investment fund. We're 25 years old. We've tried over the past 5 years to really integrate our approach and work closer both with the endowment side that has a very strong voice in the capital markets and with the philanthropy, the foundation. And this really informs both the perspective or the perception we have in terms of really leaning into risk. So we have, as you mentioned, it's like philanthropic capital is scarce capital. We care about returns, but we can take very concessionary positions. I always tend to say it's a misunderstanding to always see that, philanthropic investors should play at the first loss segment. We want to do so if we can be highly catalytic, but you'll also see us come in more commercial plays simply because it's maybe too risky. So often what I tend to say is that we would evaluate investment exactly as the same set of instruments, diligencing it as every other impact investor. I come myself from 15 years with the Danish DFI IFU. But what the main difference is that then we look at impact and we say, if we invest $10 million, there may be a risk in a base case scenario of a 50% loss. many investors will steer away from that kind of risk appetite. Well, we'll say that if we can demonstrate, a de-risking factor, if the impact that we can still achieve, even if we lose 50% of the capital, is worth it, we will consider it. And I think that's a big difference. And just briefly on the instruments, very, very flexible. So positions down to $1-3 million, direct debt equity mezz, funds, platforms. We did a $100 million guarantee at the tail end of COVID, where we made it to Gavi, the Alliance for Vaccines. We did that in 2 months. That's also, the rapid scale you can move when you are a private organization. And then the last point I wanted to make is just an impact and how we look at that. It's more than direct impact, it's systemic impact. And we really try to leverage the Soros tools or the family of Soros tools at our disposal. So every investment portfolio we construct or thesis really cares about human rights, equity, and justice. And I'm sure we'll come back to what that means.
No, absolutely. And so I suppose from across the range of different things you're doing, it really, from your perspective, comes down to where can you have the greatest catalytic effect in terms of which is the right way of thinking about particular businesses and what you can achieve.
Absolutely. So leaning into, where a lot of we know that there's a gap in terms of financing, in particular when we look at climate, but we also know that gap is more significant in many of the very vulnerable countries. So I think having that catalytic effect of being a first mover. And again, innovative financing structures is also something that we're very interested in and want to explore more.
Yeah. Okay. And Joseph, coming to you.
Yeah. I guess before I start to talk about DEG, I need to put this into context. So DEG is part of KfW Banking Group. We are a 100% subsidiary. I don't know to what extent you know KfW Banking Group. It's the third largest German bank and with 500 billion in assets. A lot of that is German business, but there is a big chunk in emerging markets. That's KfW Development Bank, and they do more early stage business. So that's they use funds from the ministry. They do blending with own resources. So, and what they do is to some extent similar to what we just heard. So the risk profile is very different. The investments don't need to be profitable necessarily, depending on where they invest. So this is, they are kind of earlier in the life cycle of the project. And ideally, projects, KfW does sector development, and then it's being transitioned, and then DEG comes in. And that brings me to DEG. So DEG is a typical DFI. So we do finance projects in emerging markets and developing countries with a quite broad mandate. So we are active in Africa, but also in emerging Asia and Latin America. So very broad regionally. Also industry-wise, very, very little restrictions beside the usual exclusion list. We do invest in almost every sector. When it comes to products, we have a big portion of our business is investment in equity. So on the one side, it's fund business, PE fund business. Venture capital is relatively new, but that has been identified as a strategic topic. And then we also want to co-invest, to invest directly, and in particular want to co-invest with PE funds. That's part of our strategy. Yeah, so on strategy, the headline of our strategy is like, it is indeed impact, climate, and returns. So there is a focus on returns besides focus on impact and climate. So what does that mean? So, well, let's say we need to achieve an adequate return on company level with acceptable volatility. That's another issue because, having a high exposure in equity, you can imagine, the crisis through which we went, created a lot of volatility. So we try to manage that. It's impossible to avoid volatility. That's part of our business, but we try to manage it. So yes, there is also focus on profitability.
And do you almost find that there's perhaps, to some extent, more of a conflict for you to address? So, for example, when you've talked, Catherine, from the Soros side, you're there very much, you're putting the capital in, it's going in early. Whereas, if there are significant downsides at some points, that's something that you're kind of comfortable with on the basis of the potential catalytic effect. Whereas I guess, Joseph, from your perspective, you're kind of trying to balance that a bit more and have a risk of a sort of conflict between whether it's the growth, the profitability, sustainability in the environment.
Yeah, absolutely. So absolutely. I mean, is there a conflict? At least there is tension, and let's call it that way, tension. So I think most of our customers, those we in the end do business with, you know, they look at impact and climate as kind of a value add for them. They have a long-term perspective, so they want to differentiate themselves from others. So I think they are ready to make an investment in climate and impact. And without that, I think it's simply not doable for us. So we need to see that willingness, including willingness to invest. So if that is not there, we cannot do business with them. So yes, there is a conflict, but again, most companies would see that as an opportunity.
Yeah. Well, look, maybe to sort of move the discussion on a little bit. I mean, I'm conscious that a number of you, and maybe Catherine, I'll come to you first, are obviously, you know, LPs who've been investing in this market for a number of years, and you've perhaps seen GPs come and go at different times. So really, I guess, just stepping back, therefore, from very much from the LP perspective, what are some of the changes that you're seeing in developments in the market today?
So I'd say in terms of, we all know it's become very difficult to fundraise. I think the LPs are becoming, you know, more critical in terms of what we want to invest in. What we've seen is lately, you know, that not everything, but there's a lot of, you know, it has a climate label. And we saw like 3-4 years ago, it was, you know, the gender label. And what I think that we would like to see is that basically there's a kind of see a more cemented theory between the climate investment mandates of the GPs in the market. So I think that's one of the things but we see more innovative financing structures. We are very pleased to see that, you know, where the real gaps are, and if we look at climate financing, historically, everyone is looking for the bankable projects or for the pipeline of bankable projects, and very few tend to see that there is enough. And here we see some new innovative structures, typically platforms that also, you know, gather multiple GPs, so to share mandates. So I think that's also pretty new in the market, that you don't just bank on one GP, but you say that here there's actually complementarities amongst GPs, and then solving for more early stage financing. And that's, of course, from our perspective, looking at those riskier set of transactions.
Yeah. Maybe I'll ask that as well to you, Anita, in terms of what you're seeing in the market at the moment.
Yes. Well, for us, what's a new trend that we are seeing, similar to what Catherine mentioned, is also during the past week and a half of conferences that I have participated in, everyone is raising a climate fund or investing in a climate fund or working on a climate project. Those mean very different things. So they go from sustainable infrastructure to nature-based solutions. In our case, given that we are a foundation, we are focusing on the harder to solve problems. So we have a focus in terms of the new trends on nature-based solutions. So that means avoiding deforestation, reforestation, conserving and restoring peatlands, coastal and marine ecosystems, and how do those projects generate carbon credits. And also beyond that, given that the UBS Optimus Foundation has a focus on impact-linked financing, how do we think about community and biodiversity outcomes alongside carbon credits? This has been a key theme for us as a foundation, and one that I expect to strengthen.
So developing into different areas. And maybe Joseph, to talk to you briefly around, I guess, DEG's, you know, very clearly announced, you know, it's sort of net zero ambitions. How do you as an organization are involved in sort of supporting your customers on their path to become more environmentally sustainable?
Yeah, first of all, it's really climate has, I mean, to that to the last question, is a seismic shift in my view in the industry since a couple of years. So we have seen many changes in strategies and topics that dominate the industry, but this one has really come in a very massive way. So I mean, this conference, most of it or a lot of it is about climate. So I mean, how is this reflected in our organization? So I mean, and this is really a big change for us. So we are what we want to be in the portfolio climate neutral, CO2 neutral by 2040. That's 16, 17 years. So that's not too much. So that is a massive change that will lead to a massive change in our portfolio, in the way how we which projects we pick, how we deal with projects. So what does it mean? So there are three parts of the strategies. First of all, it's about reduction of CO2 heavy projects. So you avoid emissions. So I mean, this leads to the fact that, for example, DEG and others as well do no longer finance gas-fired power stations. So I mean, there was one comment in an earlier panel today. So this is a bit unfair, but this is reality. So let's face it. So that's a big shift. You may say that's not helping the customer, but then there is another element, that's transformation. So that's a big element of and that goes to your question, a big element of our strategy. You cannot say as a DFI financing the private sector, I'm fully avoiding high emitters, because high emitters like the cement company, they are important for development. So you need to help them to become transformative, and this is not something you can do from one day to the other, but help them, on their way to become a smaller emitter to the extent that possible. So that's possible. And how do we do that? We have TA programs since long, but we have very much, focused our TA programs on these topics. So like today and tomorrow, there's a carbon training for our GPs in the Africa PE space. So we educate them. We have programs for corporate customers for energy efficiency. So that's indeed heavily subsidized. Actually, it's free for most of them. That's a heavily subsidized program to help the customers to reduce emissions. So there's a lot we do with our TA, and TA has been sharpened. And lastly, maybe that goes beyond the question. Lastly, there is as I just explained, you're not able to fully avoid emissions, but we have that ambition to be climate neutral in the portfolio. So what we do is, on that last topic, we offset. So we invest in offset projects, which can be carbon sink projects. The idea is we invest now, we create carbon credits over time. It takes a long time. And then at a certain point in time, we have these credits and use them to offset the emissions in our portfolio. This is, for the rest, for the balance that remains.
Yeah, no, understood. And the point you made there, I think, is a really important one, and it's very much how we would look at this area as well. That energy transition is not an outcome. Energy transition is a journey, and therefore you need a huge amount of businesses and the environment to adapt as part of that. And actually, to simply shut off funding day one is not going to be the best way of driving and helping those businesses on their journey to become more environmentally sustainable. So, yeah, I think you make a good point there.
In terms of what we see also, as we discussed in the video before the session, is the voluntary carbon markets and carbon credits is a key when we look at the climate investments. There's a lot of fund managers that have that component. And I think it's super interesting. We're doing a project now in Brazil that has this element of voluntary carbon credits, but it's also a market that is pretty nascent, that is not really regulated. So it's going to be interesting to see, the track record and how that is going to perform going forward. But it's one of those new features, and it comes with biodiversity credits. There's so many different credits now that it's almost impossible to keep track. But yeah.
And that comment around having multiple different regimes, it not being regulated, it being quite hard to measure the impact of things. Maybe, I mean, that's obviously one very specific example in the context of a sort of new nascent market. I mean, Dia, maybe I could come back to you and just think about that topic a bit more broadly. You're obviously sitting there as DFC, as you touched on earlier. You would sometimes be investing in more like startup businesses. Other times you've got businesses which would be, large renewables projects. I mean, how do you think about sort of from an institutional perspective about the sort of development, what is being achieved from a sustainability perspective when you've got such a diverse portfolio?
Sure. I think there's two levels to it. So first, you look at it from the top down. We as an institution have made a commitment that at least 1 in 3 investments are climate focused. We've also kind of put a face to it. We now have a chief climate officer and a deputy chief climate officer. On every transaction, as we bring it through the process, there's a climate screen to it. I also want to add there's a gender screen as well and a gender equity component. And we're very much interested in the intersection of gender and climate. So that's the top level. On the transactional level, this not only gets to having that climate screen, as I mentioned, for every transaction, but looking at the types of deals that we do. So we're also looking at adaptation and mitigation, which means we're expanding our view of climate to different sectors, to agriculture, to some of our manufacturing or food processing sectors. So we're looking at it all around. And then also I'd say the last point is we're willing to take that risk. So we have a few clients within our program, specifically the Portfolio for Impact and Innovation program, that I mentioned, where we're actually looking at a part of our return being based on our clients' ability to really capture that carbon credit market. So we're willing to be forward leaning in the way we take risk and kind of align it with what we believe our institutional values to be. And then the last thing I'll say is when we transitioned to the DFC, previous to that we were OPIC, one of the products that we gained in our toolkit was technical assistance. And we're using that technical assistance to kind of put our money where our mouth is. So we're looking more at being very developmental, really helping to prep our clients and prep different projects that we finance to give them those tools that they need to be more climate focused and to really institute some of the things that we require as part of our investment process.
And so it sounds like a key part of that is kind of ensuring that you're setting up, you just mentioned the loan structure there, ensuring that there's alignment between your overall objectives and what you want the underlying businesses to be achieving.
Exactly, and that they have the support to achieve our objectives as well. Because for DFIs, they can often be very demanding on clients, especially smaller companies as they're growing and developing.
Yeah, and maybe, I guess, Catherine and Joseph, obviously your organizations are involved in investing across multiple markets. And obviously you will have particular, like the sort of the development effectiveness ratings that DEG has. When you're sort of trying to come up with the right way of thinking about and applying those ratings, how does applying that to businesses in Africa compare to perhaps businesses in other jurisdictions that you're investing in?
Yeah, the system is quite flexible. So I mean, obviously the market conditions and the challenges in the markets are very different when you compare Africa with emerging Asia. I mean, when you look at the components of the there are various components. I can explain that in more detail. So I mean, one factor or one component may be more relevant in Africa, say local income. I mean, local income is relevant everywhere, for sure. But it may be even more important in the African context than in more advanced Asian economies. But there you may have other factors that have a heavier weight. So I mean, you have to apply the system in a flexible manner, and then you get, I think, the proper outcome. I think the system is quite flexible and designed for emerging markets in general.
Catherine?
Yeah, no, I would add that we built that there's a lot of experience that we have accumulated over the years when we've invested in, we had a thematic area that was smallholder farmers. We have had a gender lens or empowerment of women. And I think there's a lot now that we look at the climate space, like a lot of experience and lessons learned that we can draw when we look at our experience in Africa. I think I would look at Africa's, there's so much opportunity. And I think that, again, it's easy to say, to shift, from only perceiving the risk and shifting that into an opportunity. And I think we're going to touch upon that, because that also comes with how do you then try to de-risk? How do you basically structure the investments? And I think what we've seen, and it's not a secret, right? A lot of these conferences, when you get around the tables, if it's philanthropic investors or it's DFIs, we all must admit that if we look at our GP or our fund investments, very few have been super top successful in terms of earning very high carries as compared to markets in Asia or Latin America. And often there's also the struggle about exits. So how that it takes longer time, that even your 10 plus 1 plus 1 are maybe not sufficient. So I think this calls for, again, creative mindsets that try to structure this in a different way. And I think this also comes with an incentive that I would not fear, but I think we need to steer away from the fact that managers in the more risky but with lots of opportunity markets have a tendency of always thinking about the next fund they're going to raise, because that is going to make the fund managed sustainable, because you get your management fee. And then it's, we as LPs want to see a hardcore, very laser-focused effort from the LP. So in my mind, I don't have a solution, but I think there's really something to think about in terms of how do we incentivize, motivate, and there's probably a push that needs to be done more on the continent than what we've seen in the more mature markets.
And that we've certainly seen a number of new and emerging GPs across the continent, which is fantastic to see. And actually, especially those GPs coming through now often will have the sustainability metrics embedded in their sort of DNA right from the start. So look, we've got a sort of 10 minutes or so left. Are there any questions from the floor at this point? Four of your potential LPs up on stage? No questions for them? Okay, well, we'll maybe come back at the end for any last questions. But maybe another area that we've, I guess, touched on with thinking about the catalytic side is really about what more can be done in terms of mobilizing capital. And maybe, Anita, to come back to you, and you talked a little bit around the UBS Optimus structure that you'd put in place earlier this year. I mean, do you see that kind of structure of having investors there that are taking some of the first loss? Do you see that as a way of unlocking more capital that is going to have an impact focus?
Yes, so I definitely see blended finance as an important tool to unlock more capital towards the SDGs. To give you one example, a recent UBS survey found that 95% of the billionaires want to lead the way when it comes to impact. And that doesn't only mean philanthropy, that also means their wealth that they use for investing. Another finding of the survey is that about 60% of the wealth is going to be passed on to women and to the next gen, so young people who care deeply about impact. So because philanthropy and public financing is not enough, the question is how we will mobilize the wealth which is out there through philanthropy and public financing towards the SDGs. So one example that I've mentioned is the SDG Outcomes Fund. It has a philanthropic share class. It's actually not a first loss, it's a last out structure. So first, more senior share classes receive distributions. And an interesting component of it is that the philanthropic share class does receive an upside if the fund performs really well. So moving a little bit the conversation away from concessional funding and subsidizing investor returns, and moving it more into the catalytic nature of the philanthropic and public funding. I would say another component for us is how do we use philanthropy in order to build investable pipeline. We do that quite a lot, especially now in the nature-based solution space. So we do fund initiatives, venture builders that will demonstrate that there is investable pipeline and that these funds, may those be blended finance funds, can invest in.
I mean, it strikes me that there are some, and certainly from chatting to you about it separately, there are some real difficult areas to work through with investors in circumstances when you've got investors who might naturally have been not investing in exactly the same business are now coming together within a single blended finance product. So it's fantastic that that fund is out there, it can go and spend the money, but actually where the thinking around how those different pools of capital fit together has to then be agreed and aligned on and then recorded as part of the fundraising. So I'm sure that has a few challenges to work through at times.
Yes, absolutely. I would say there is definitely a challenge around just scale of these products. I think we have found that there needs to be a certain scale in order for the economics to make sense. And so as a foundation, we have been engaged in a number of quite small projects. It's okay as pilots, but then we need to think about how we make them sizable. Another area I would highlight is just the complexity or the perceived complexity, which can be a key barrier of entry to some of the LPs who are more used to plain vanilla structures. So it is not necessarily that we need to move away from more complex structures. I think it's more around the narrative that we create around those structures that we need to work on as a community of investors.
Yeah. Okay, so that's sort of blended finance. Another area which I guess we just want to touch on, and Dia, maybe I'll come to you. You and I were chatting earlier around the Sun King securitization, which was secured earlier this year. A pretty high-profile transaction where you had a business that is providing power directly to households, was in a position to raise 130 million worth of Kenyan shillings with a novel securitization project. And I was asking the panelists about this, and Dia made the point that actually you had been an earlier investor in that business, which I thought was a really good example of how actually this impact investing and what this can achieve in terms of the life cycle.
Yeah, so we're really proud. We consider that investment one of our success stories. 7 years ago, we were one of the first institutional lenders to Sun King, what we called at that time Green Light Planet. And to be able to see them scale and grow kind of off the back of the initial investment, debt and equity that they received from many, including DSC, is really just an example that we thrive on and what is really our goal. And just to add on that, that's how we look at partnerships. So when we think about partnerships, we think about partnerships with other investors. We're participating in the SDG Outcomes Fund and other work with UBS. We've worked with Soros as well. But we also look at partnerships with GPs. And that's one of the foundations of a lot of our debt financing, especially at earlier stages, to look at different GPs that are on the ground, that are working with the clients and know them well and are able to offer that early stage, maybe equity capital and provide the non-financial support, being able to leverage that and come in with debt financing directly to those clients. So we always want to look at creating partnerships, not only with other LPs, but also with GPs so that we can invest directly in companies.
Okay, so an important role for partnerships. And maybe just to finish off, and maybe I'll ask sort of each of the panelists, obviously one of the areas that those partnerships can drive is also unlocking more local capital. And I guess perhaps, Joseph, to you first, what more it can sort of all of the people be doing in this room in terms of helping with unlocking more of that local capital?
Yeah, that's not the easiest question. No, I mean, it's absolutely necessary to mobilize local capital and more private capital in general. So, I mean, these are two urgent necessities in the African market. So I from a DFI perspective, I think general answer would be we need to be complementary, catalytic. We need to take risk in order to facilitate the entry of private capital. So to make this more concrete, what we have done, for example, is we have started a program to be a cornerstone investor in bond issues, African bond issues. So we we are the first or among the first investors in large bond emissions, which then facilitates the entry of other investors in bonds, for example. So this is very important. And besides that, I mean, what DFIs have been doing traditionally is, providing the riskier part of the finance, which facilitates private local capital. Like, you take the longer end in infrastructure finance, for example, like 15, 20 years, whatever is required. This is one element. You could take the riskier mezzanine parts, for example, which then facilitates, local senior tranches. So there are various ways to facilitate the entry of private capital. But I think it's a big challenge for us to develop capital markets in Africa. They are simply, I would say, underdeveloped. When you look at the public markets, there are only a few stock exchanges that really work. So that part is not working well enough. And also in the debt markets, there are a lot of challenges and there is a lot for us to do. So.
Yeah, and obviously kind of impact in global debt markets will also have an impact in Africa and can at times slow down that development.
Yeah.
So.
Yeah.
And Catherine, maybe come to you just to finish off.
Yeah. So I think in terms of the private capital, so it starts off in maybe not being local, but we've seen over the past 10 years a lot of more foreign pension capital, so private capital that has an appetite for more risk, that for some of it flows through the DFIs, but we've also seen now that pension funds come directly into these markets. And we've seen, some structures recently that really try to accelerate that flow of capital. And we want to see, more local capital. And I think the way to do it is also to require that. What is a medium to long-term plan to bring on that local capital? So engage with the local players upfront. And then, in terms of getting more philanthropic capital to de-risk the proposals, I think I really like the new structure of not saying we don't have access to the upside. It's okay that we take first loss positions, but if there's an upside, we want to also be remunerated for the fact that we take that first loss risk. I think that has unlocked more appetite already. So.
Okay. Well, look, on that point, I just like everyone to put their hands together and thank our panelists for those interesting insights.